What's up, everybody? It is Wednesday, November 11th. Veterans Day. Salute to all the veterans out there. NASDAQ tech stocks bounced back today. Remember yesterday I said that tech stock sell-off from the prior 2 days, that was overdone. We're still in a bullish environment. For the overall market too. But I said that whole tech stock thing where everybody freaking out and you had a rotation. You had to buy the NASDAQ, and I sent out an email to my subscribers, and you know, we bought the lows and you had to bounce back. Couple of things bothering me here though, I'll let you know. Number one, guess who's back in the news? For me anyway, Jeffrey Gundlach. Jeffrey Gundlach, who's been bearish on the market for like forever, it seems like. I mean, this guy, he's, you know, again, I mean, I could do hours and hours and hours of talking on how these guys, they're basically clueless. And somehow, you know, they get these jobs where, or they tap into institutional money. They don't really do very well. They're basically, you know, a little tiny alpha over a risk-free return. They're personally rich because they get a percentage, they get a management fee on billions and billions of dollars. But, you know, I'm not going to get into this discussion. Anyway, you know, he's bearish, he's been bearish, the market's going up. You know, none of these guys ever talk about the fiscal policy, fiscal support, which is, you know, unprecedented. I mean, again, you know, the government spending all this money, that's a transfer from the government to the non-government of income, of savings. You know, it's flowing to somebody. They don't get it. I mean, to them, it's something. It's always something about the Fed or, you know, the COVID. Anyway, Gundlach, he says the market's going to have a big crash, and you know, maybe in like 18 months. I mean, that's kind of like useless information. All right, like maybe in 18 months from now, and you better start preparing. And it seems to me like he's always putting out these kinds of forecasts. Like the market's going to have, yeah, you know, we're going to have a correction. I mean, telling people, hey, 18 months from now or somewhere between now and 18 months, what kind of, I mean, how does that help anybody? You know? How does that help anybody? It's like all of these guys, like Schiff and all of them, you know, it's going to crash one day. One day, well, yeah, one day, you know, the earth is not going to revolve around the sun anymore either. I mean, it's useless information. But the other thing, here's the thing that bothers me, not so much about him saying the market's going to crash. I mean, I like that because that just makes me even more bullish. But he said you got to stock up on gold. You know, now I've been long gold now for basically for 5 years. I mean, since 1050, and I've been telling people the whole entire time. I mean, if you've been following me, like every pullback. And you know, that was a factor of monetary policy shifts. It was a factor of fiscal expansion. It was a factor of, you know, expanding U.S. deficits, that kind of stuff. It was a factor of the dollar being in a downtrend. And I'm still bullish on it. But when you have these guys coming out saying, hey, pile into gold, I mean, that's a red flag right there. I'm not saying we're going to have a deeper correction now, but, you know, there's things I look at. And by the way, I think right here at 1850, 1860, that's some pretty solid, good support. But we'll see how it turns out. So that's number one. Number two, Bill Ackman, another one of these hedge fund guys. Like, he put on some bearish position too, I was reading. Now, he put on like a bearish credit position. So like he's expecting, I guess, a lot of companies to go under because of COVID. And so I guess his position is he's basically shorting the bonds, or through some instrument, some proxy, he's like shorting the bonds of certain grade of credit. That could happen, but I mean, Supposedly Ackman, he made a lot of money doing that earlier in the year, like December, January, something like that. And I think, in March he covered his position. But we didn't have the kind of fiscal support that we have right now. Now, I'm not saying that the COVID situation is not going to have an impact. I mean, it may already be having another wave of negative economic impact. Like, I'm looking at corporation income taxes, and I think I mentioned this, that recently they stopped going up. Now they're up year over year, but they stopped rising year over year. They're flat. They're still up, but they're not accelerating higher. So that could be an indication. I'm keeping an eye on that. But I mean, these guys, I don't think they're very smart. Yeah, they manage a lot of money. Their returns are very often, if not always, less than the historical returns of the market itself. So I don't see what value they provide to anybody. They're all in a big club. They all know one another. And that means other big hedge fund guys, institutions, they get institutional money to manage because they're all in that club. But frankly, you can basically buy a 10-year treasury and have better performance than these guys. I'm just saying. None of them understand MMT. None of them talk about the fiscal situation. So I like to kind of go against them. All right, and then there was one other guy, Ken Rogoff. Maybe some of you have heard his name. I've done videos on him in the past. Ken Rogoff is a Harvard economist. He famously wrote the book, or infamously wrote the book, I should say, It's Different This Time, 700 Years of Debt. This was back, I don't know, in the early 2000s, I believe, where him and Carmen Reinhart and Rogoff, you can Google that book. They supposedly did this big book about how when a country's debt threshold reaches a certain amount, I think they said it was like 90% of GDP, then all hell breaks loose. The only problem was the book and the data and the analysis was rife with errors and omissions. It actually had a University of Massachusetts graduate student go through the actual Excel data, Excel files, and was able to discover all kinds of omissions and changes in the data. I mean, it was a disaster. And the other thing about that book, every single example in that book that they used, there was not one example of a country, a sovereign currency issuing country that involuntarily had to default on its debt. Like, it just doesn't exist. And they tried to make this blanket case where, hey, if you reach 90% of GDP, then all hell's gonna break loose. Well, look at Japan, has like 220% of GDP. I think we have like something like 140% of GDP or something like that. And like rates are at zero, the dollar's stable. But that's what I want to talk about, because he's saying, uh-oh, the dollar's going to crash. Now, I'm bearish on the dollar, but like my bearishness on the dollar is, I'm not crazy bearish, because monetary policy is very bullish for the dollar right now. I mean, the Fed's zero interest rate policy, asset purchases, the only thing that is keeping the dollar in a very, moderate downtrend is large budget and trade deficits, major fiscal expansion. But like when I see Rogoff getting bearish on the dollar, man, it makes me nervous for my position. It really does. I'm sticking with it for now, but it makes me nervous. Anyway, I put up a new podcast. Go check it out. The link is right here in the description below. See everybody tomorrow. Bye-bye.